Warren Buffett is the greatest investor of all time. He's also made some of the most expensive mistakes in stock market history. And here's the part most people don't know. He talks about those mistakes openly, publicly, in detail. Because according to Buffett, understanding what goes wrong is more valuable than understanding what goes right. In this video, I'm going to walk you through the 5 biggest investing mistakes Buffett has admitted to making, some of which cost him billions of dollars, and more importantly, the lessons he drew from each one that you can apply to your own portfolio today. Mistake number 3, by the way, is the one he calls his most costly error ever. Not in dollars, in opportunity. Stay with me. Most investors hide their mistakes. They bury the trades that went wrong, forget the timing errors, and only talk about the wins. Warren Buffett does the opposite. Every year, in his letter to Berkshire Hathaway shareholders, he publicly documents what he got wrong. Pause. What he missed. What he overpaid for. What he held too long. This isn't humility for its own sake. It's a system. Buffett believes that the investors who study failure, especially their own, develop a kind of pattern recognition that eventually becomes an edge. You start to see the same mistakes appearing in different disguises, and you stop making them. Over the past 60 years, he's made mistakes that cost Berkshire tens of billions of dollars in losses and hundreds of billions more in missed opportunities. Here are the 5 that matter most. Mistake 1 is about the most common trap every investor falls into. Mistake 3 is the one that haunts him to this day. And mistake 5 is something he didn't admit until decades later, and it completely changed how he invests. Let's get into it. Mistake number 1, buying Berkshire Hathaway itself. In the early 1960s, Warren Buffett began buying shares in a struggling New England textile company called Berkshire Hathaway. His plan was simple: buy cheap, sell when the price recovered, move on. Then the company's management made him an offer to buy back his shares at a price slightly below what they'd verbally agreed to. Buffett was furious. Out of spite, he kept buying until he controlled the company entirely. He was now the owner of a dying textile business. For the next 20 years, Buffett poured capital into keeping those mills running, trying to compete with cheap overseas labor until he finally shut them down in 1985. He later calculated that if he had simply invested that same capital into insurance businesses from the start, Berkshire would be worth twice what it is today. His estimate, over $200 billion in destroyed value. Pause from a petty argument. Never let emotion drive an investment decision. The moment Buffett let anger override analysis, he locked himself into a bad business for 2 decades. Price alone is not a reason to buy, and pride is not a strategy. Mistake 2 is subtler, and it's one that experienced investors are actually more likely to make than beginners. Mistake number 2, overpaying for Dexter Shoe. In 1993, Buffett acquired Dexter Shoe Company for $433 million. He was convinced it had a durable competitive advantage, a genuine moat. It was profitable, well-run, and American-made. He paid for it, not in cash, but in Berkshire Hathaway stock, 25,203 shares. Within a few years, cheap foreign competition destroyed Dexter's business model entirely. The moat Buffett thought he saw didn't exist, or it evaporated faster than he anticipated. Dexter was worthless within a decade. But here's what makes this mistake truly painful. Those 25,000 shares of Berkshire stock he used as payment, by 2007, they were worth over $3.5 billion. He didn't just lose $433 million. He gave away $3.5 billion to buy nothing. Never use your best asset to pay for a questionable one, and be brutally honest about whether a competitive moat is real or assumed. It seems like a moat is not the same as it is a moat. Do the work. And now, mistake 3. The one Buffett himself says is his most costly error, not in terms of money lost, in terms of money never made. Mistake number 3, missing Amazon and Google. In the late 1990s and early 2000s, Warren Buffett watched Amazon grow from a small online bookstore into one of the most powerful business models in history. He watched Google build an advertising monopoly that generated billions in near pure profit. He understood both businesses. He admired them. He even said publicly that Jeff Bezos was one of the most impressive business builders he'd ever seen. He bought neither. Buffett has been clear about why. He didn't fully appreciate how durable their advantages would be. Amazon seemed like a retailer. Google seemed expensive. He applied his traditional valuation framework to businesses that required a different lens entirely. One based on network effects, platform economics, and winner-take-all dynamics. A $1 million investment in Amazon in 2001 would be worth over $1 billion today. Google's numbers are similar. Buffett called missing these a huge mistake of omission. Not what he did wrong, what he failed to do at all. Your circle of competence needs to grow with the world. The framework that made Buffett billions in the 20th century was not perfectly suited for the 21st century's dominant businesses. Recognizing when a new business model has created a new kind of moat and having the intellectual flexibility to value it is one of the hardest skills in investing. Mistake 4 is one that most retail investors make every single week, and Buffett made a version of it too early in his career. Mistake number 4, holding too long, the airline trap. In 1989, Buffett invested $358 million in preferred stock of U.S. Air. He was attracted by the preferred dividend and what seemed like a reasonable valuation. He later described this decision as made in a weak moment. The airline industry is structurally brutal. High fixed costs, commodity pricing, union labor, fuel volatility, and cutthroat competition mean that almost no airline has ever generated consistent returns over long periods. Buffett knew this. He invested anyway. U.S. Air nearly went bankrupt. Buffett eventually got out, roughly at break-even, but only after years of stress and opportunity cost. He famously joked that if he had been at Kitty Hawk when the Wright brothers flew their first plane, he would have done investors a favor by shooting it down. Decades later, in 2020, he bought stakes in 4 major airlines, then sold all of them at a loss when COVID hit. Even the best investors are drawn to businesses they know are structurally weak, usually because the price looks cheap. But a cheap price in a bad industry is still a bad investment. Industry economics matter as much as company quality. If the whole pond is poisoned, even the best fish struggles. And finally, mistake 5. This one took Buffett decades to admit. And when he did, It quietly changed the entire direction of Berkshire Hathaway. Mistake number 5, waiting too long to evolve. The cigar butt trap. Early in his career, Buffett was a devoted follower of Benjamin Graham's cigar butt investing philosophy. Buy deeply discounted, beaten down companies, extract one last puff of value, then move on. It worked for a while, until the amounts of capital Buffett was managing became too large for cigar butts to move the needle. It took Charlie Munger years to convince Buffett to shift his thinking, to pay a fair price for a wonderful business rather than a wonderful price for a fair business. The mistake wasn't cigar butt investing itself. It was holding on to that framework longer than the evidence supported. When he finally did shift, buying See's Candies in 1972, Coca-Cola in 1988, American Express at scale, the results were transformational. He later credited Munger with saving him from a decade of mediocre returns by forcing him to think differently. Your investing framework should evolve as your circumstances change. A strategy that worked at 1 million may not work at 100 million. What worked in one market era may underperform in another. The willingness to question your own successful system before it stops working is one of the rarest and most valuable skills in investing. 5 mistakes, tens of billions of dollars, decades of lessons. Let's bring them together. Mistake 1. He let emotion override analysis and spent 20 years trapped in a dying business. Mistake 2. He overpaid with his best asset for a moat that wasn't real. Mistake 3. He failed to see that a new era of business required a new lens, and missed 2 of the greatest wealth-building opportunities in history. Mistake 4. He invested in a structurally broken industry because the price looked cheap. Mistake 5. He held on to a successful framework too long, and it took his best friend to force him to evolve. Here's what ties all 5 together. Every single one of these mistakes came from a moment where Buffett let something override his own best judgment: emotion, familiarity, stubbornness, or comfort. The greatest investor in history is not immune to the same traps every investor faces, which means the edge isn't genius, it's awareness. It's knowing which traps exist and building systems to avoid them. Now, if you want to understand the system Buffett uses to make decisions when he's at his best, the mental models, the frameworks, the thinking tools, that's exactly what the next video covers. Charlie Munger spent 50 years as Buffett's partner, and his approach to thinking about problems is something completely different from anything we've covered so far. That video is right here, and I think it's the most practically useful one on this channel.